Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Capital One has officially struck a $5.15 billion deal to acquire Brex, a well-known fintech platform in the business credit space. Now, on the surface, this would seem like a massive win. Big money, big backing, big headlines. But when a fast-moving fintech gets absorbed by a traditional financial institution, the real question isn't how big the deal is. The real question is how it changes the product, the approval process, and the long-term value for business owners who rely on flexibility, speed, and business funding. In this video, we're going to break down what the acquisition really means and why it quietly changes Brex for the worse over time. And if you're currently a Brex customer, which business credit card you should seriously be looking at next. So let's start with the deal itself. Capital One acquiring Brex for $5.15 billion is not a small partnership or a casual investment. This is a full absorption into a large traditional banking ecosystem. Brex built its reputation as a fintech company designed for fast-growing companies, startups, and modern businesses that didn't want to deal with old-school banking rules. The platform focused heavily on automation, real-time spend tracking, and approvals based on business performance rather than personal credit. Capital One, on the other hand, is one of the largest traditional financial institutions in the country, and it operates under strict regulatory oversight, legacy risk models, and shareholder-driven priorities. When those two worlds collide, something has to give. From Capital One's perspective, this acquisition makes sense. Brex brings in modern infrastructure, fintech innovation, and a younger tech-savvy customer base. Capital One brings capital, compliance, infrastructure, and access to large bank resources. For most small to mid-sized business owners, though, this is where the pain points emerge. Wasteful spend becomes harder to spot without real-time visibility, controls feel less flexible, and manual finance workflows start to replace automation. What looks like predictability on paper can quickly turn into friction when growing businesses need speed and adaptability. This is where concerns start to creep in. Now, before we talk about the trade-offs, I want to actually refer to this Reddit thread that I was looking at. As we can see here, this news only broke 6 hours ago, and it's a lot of people that already have the same concerns that I do. Even looking here, you can see the reaction from a lot of Reddit users. They're talking about how this could potentially be awful for Brex. A lot of people are having the exact same thoughts, but I did want to start with an objective opinion first. Here's the part that doesn't make the headlines. When a fintech company becomes part of a traditional bank, the product almost always slows down over time. Fewer resources go into new features, and the pace of iteration drops significantly. Decision-making becomes more conservative, risk models get tighter, policies begin to favor predictability over flexibility. Brex originally built its approval system around business performance metrics like revenue, cash flow, and operating history. Traditional banks rely heavily on standardized risk controls, internal exposure limits, and regulatory pressure, and that shift matters. As Brex becomes more deeply integrated into Capital One, customers should expect product priorities, pricing structures, and approval policies to increasingly reflect the needs and constraints of a larger bank rather than a fast-moving business. That often means higher internal thresholds, more documentation requirements, and less tolerance for unconventional business models. It also means innovation slows, features take longer to roll out, exceptions become harder to get approved, and decisions that used to happen in minutes can quietly take days or weeks. For founders and business owners who chose Brex specifically to avoid traditional banking friction, this is a real concern. If you're currently using Brex, this doesn't mean your account will suddenly disappear tomorrow, but it does mean the long-term trajectory of the platform is changing. Over time, you may notice tighter spending controls, more conservative credit limits, adjustments, and policies that feel more like a traditional bank instead of just a fintech. If your business relies on flexibility and scaling without personal guarantees, it's smart to start exploring alternatives now rather than just waiting until policies change later. The good news is that Brex is not the only player in this space. There are strong alternatives that remain independent and fully focused on helping businesses save money, automate finances, and build real business credit. So let's start with the top option. If you're looking for the best alternative for what Brex originally offered, Ramp is at the top of the list. The Ramp Business Card is a no personal guarantee charge card with no interest and no annual fee. The entire platform is built around helping businesses control spending, automate finances, and operate more efficiently. What truly separates Ramp from traditional banks is its automation-first approach. Ramp connects directly to your accounting software and automatically syncs transactions in real time. Every expense is categorized instantly, reducing bookkeeping errors and saving hours of manual work. Ramp also has AI agents that autonomously handle finance work, like reviewing every expense against your policy with 99% accuracy, or answering employee policy questions via text. These agents work in the background 24/7, taking action on routine tasks so your finance team can focus on strategic work. But Ramp isn't just about cleaner books. It also helps businesses keep more money. Every purchase earns cash back, turning everyday spending into real savings. So whether you're paying for software, travel, advertising, or operational expenses, Ramp will help stretch every dollar further. Approval is where Ramp really shines. Ramp evaluates your business's actual financial health, including revenue, cash flow, and overall stability. Based on data, they assign a spending limit that you can scale up to 6 figures and beyond as your business grows. Ramp also reports on-time payments to major business credit bureaus, including Experian, Equifax, and Dun & Bradstreet. So that means you're not just accessing funding, you're actively building a stronger business credit profile at the same time. For businesses looking to move away from Brex without sacrificing automation or scalability, Ramp is the most natural transition. If you'd like to apply for the Ramp card, there is a link down in the description below. Next on the list is the Mercury IO Business Credit Card, another strong option with no personal guarantee. Now, this card is exclusively available for Mercury business banking customers, so you must hold a Mercury account to qualify. However, once you're in, the benefits are straightforward and business friendly. Mercury IO offers unlimited 1.5% cash back on every purchase. There are no complicated point systems or category restrictions. Cashback is automatically deposited into your Mercury account, keeping things really simple. There's no annual fee, there's no interest, and no foreign transaction fees. Mercury also provides exclusive discounts on business tools like AWS and Microsoft, which can add meaningful savings for tech-driven companies. Like Ramp, Mercury IO reports to Dun & Bradstreet and Equifax Business, helping you establish and strengthen your business credit profile. Approval is based entirely on your business finances rather than your personal credit. Typically, Mercury looks for a minimum average cash balance of around $15,000, though this can fluctuate depending on your account activity. Because there is no personal credit check, approval depends on the health of your Mercury account rather than your personal FICO score. So for founders who want clean separation between personal and business credit, this is a major advantage. Another solid alternative is the Bill Divvy Business Card, a corporate charge card designed for structured spending and team-based budgeting. Divvy allows businesses to generate physical and virtual cards, assign budgets to specific team members, and create one-time use cards for events or vendor payments. This makes it especially useful for companies with multiple departments or recurring vendor expenses. Like other corporate charge cards, Divvy does not allow you to carry a rolling balance. The full balance must be paid in full according to the selected billing cycle. Failure to do so can result in account suspension. Divvy offers weekly, semi-monthly, and monthly repayment options. Businesses that choose weekly or semi-monthly repayment are rewarded with higher points, multipliers, incentivizing faster repayment cycles. Businesses must spend a minimum percentage of their credit limit each month, meet category caps, and maintain the account for at least 12 months before redeeming certain rewards. Despite those requirements, Divvy remains a useful option for businesses that prioritize spend control, internal accountability, and structured budgeting. Capital One acquiring Brex is not inherently bad news, but it does signal a shift in priorities. As Brex becomes more embedded in a traditional banking environment, business owners should expect slower innovation, tighter policies, and decision-making that will prioritize bank stability over entrepreneurial flexibility. If you value speed, automation, control, and no personal guarantees, it is smart to diversify now or transition to platforms that remain fully focused on business owners rather than bank shareholders. Ramp stands out as the strongest Brex alternative, offering automation, cashback, scalable limits, and real business credit reporting. Mercury IO and Bill Divvy round out the list with solid options depending on your banking setup and operational needs. The key takeaway here is simple. Business credit works best when it's built intentionally and proactively. Waiting until policies change usually means fewer options and tighter approvals. If you found this breakdown helpful, make sure that you subscribe to the channel so you don't miss future updates on business funding, credit strategies, and financial tools that actually help you scale. Thank you so much for watching, and I'll see you in the next video.